Liquidity tells you nearly everything you need to know about the markets. It can help you predict where markets might trade to in the future, where traders are trapped or offsides, and where you should place logical stop loss and take profit orders. The problem is most traders have a hard time identifying liquidity and the story it tells us. So in this video, I'm going to share everything you need to know about liquidity and how to start thinking like smart money. But before I do, I want to share with you my step-by-step strategy, all for free. This strategy has helped me make over $1 million using prop firms in the last couple years. It's allowed me to trade full-time, travel the world, and even retire my wife in the process. So if you want to know how I was able to do it, make sure you check out the PDF link in the description. Now, without wasting any more time, let's get into the video. So I'm going to teach you guys everything that you need to know about liquidity. All right, first of all, what is liquidity? In simple terms, it's a measure of how many buyers and sellers are present and whether transactions can take place easily, right? Very simple definition. But when we're trying to analyze the markets, right, what can it do? It can help us determine a bias. So really just understanding what direction or a probability of what direction the market's going to trade to with greater certainty than just a coin flip, right? So we're trying to determine the future direction of the market, and liquidity can help us do that. It can provide insights into possible targets and stop loss areas, and it'll tell you when the market is low versus high probability. So these are all important aspects of learning liquidity and studying it in real time and helping build a narrative around a trade idea. So when we're trying to place trades in the market, all we're doing is really taking an educated guess. And what we're going to see is at times there's going to be reasons for a market to go higher and lower. And when it's unclear and when you're having a hard time determine with greater probability that the market is going to go one direction over another, then oftentimes it's going to result in you needing to sit still until things are more clear. So when we're trying to trade, we're just trying to find weak levels of liquidity or important levels that we believe are going to be taken in the future, where markets should trade to. And this is a famous quote by Jim Rogers. He's a legendary trader. If you guys don't know who he is, you can look him up. And essentially what he's saying is he just waits until there's money lying in the corner, and all he has to do is go over and pick it up. In the meantime, he's doing nothing. And this is one of my favorite quotes when it comes to trading, because that's essentially what you should be focused on. You should be focused on setups that make the most sense to you and are easy trades. And now, not every trade is easy. Yes, there's a lot that goes into an easy trade, but what we're trying to do is take the path of least resistance. We don't want to fight the markets. The markets will provide opportunity, and it's our jobs to just capitalize on that opportunity. We don't want to, fight the markets and really go against the grain of what the markets are telling us. And that's part of building your narrative and building your bias and using liquidity as a strong tool in your toolbox to help you understand what direction is the market likely to go. And if we don't have that likelihood, then we do nothing. All right. So the point of this video is to help you guys just visualize liquidity. And the reason I bring this up, and a lot of you guys can fight me on this. This is how markets work. So a market works on an order book. Now, a lot of you guys might even just completely ignore what I'm trying to tell you, but I'm just trying to build some logic into why you should have a specific trade idea. So what we're looking at is an order book, and we have the asks and the bids. So essentially what happens is when we are trading at this market price, and we can see that this is the current market price. Okay, so we have 38,594.50. We don't know what asset this is. It doesn't really matter. You guys can see that the next ask is 38,595, and then the next bid is 38,590. So the markets need to come into agreement, and these orders will be paired with each other. And when liquidity dries up on one side of the order book, markets tend to reverse. So if there's not enough people bidding a market, right, the bids will dry up and the markets will fall off. And if there's not enough people offering, so if there's not enough people selling, markets will drive higher. Okay, so that's essentially what we're trying to visualize when I get into the next couple slides, because it's going to be very, very important. So think about all these levels in here that, the total, we have volumes in here. Okay, so we have actually sizes. What we're going to look for is the size. This is so important because as the market trades higher, a lot of these orders are going to be neutralized. So each time the market trades higher and higher, it's going to eliminate all these sizes or orders on the book, right? And what's going to be left is bids. So there might be bids that are popping up as the market's trading higher, right? Because it's eating up all these ask prices. And that's really what I want you guys to pay attention to when we're looking at market structure and liquidity, right? We have specific orders above this level, but when it trades above that level, it's neutralizing a lot of those orders. So when somebody is short or trying to enter long on a breakout, there could be two different participants in the market. We have stop loss orders or, buy limits. Buy stops or sell limits. So what we're looking for is we're just trying to put this into a logical perspective. Essentially what happens is we have, points where money is being built up or liquidity is being built up above and below old highs and old lows. All right, but once markets trade above and below them, oftentimes that liquidity becomes neutralized, right? It sucks the orders out of the market. So when a market fails to take out a previous swing, the existing orders on the order book do not get filled, therefore creating a pool of liquidity. So let's just say, for example, I went long here, and I'm going to put Kyle or Jade Cap, and this is my long entry. So I'm going to go long. Doesn't matter what the price is. What am I going to do to protect my order? All right, I'm going to have a sell stop below the market. All right, so if you can see this on an order book, what's going to happen is, let's say if I'm long one contract, I'm going to have a sell stop of one contract. And this one contract here is going to show up on the order book. What's going to happen is, if we fail to take out that low, what happens? Nothing happens. My order is still on the order book until I do something with that trade. And let's just assume that I don't do anything with the trade. That means all of the liquidity that I'm creating in the marketplace doesn't go anywhere. What happens if not only I'm going long, but what happens if Jerry goes long and Mike goes long? What's going to happen is there's going to be a buildup or a pool of liquidity that's being created below this old low. So my one contract might turn into 2 or might turn into 3 or 10 based on however many contracts Mike or Jerry are adding into the marketplace. Okay. So this is creating the pool of liquidity. It's just based on the fact that we have an old swing low here. And what most likely occurs is more and more orders, as this market trades away, right? More and more orders are getting placed in the order book, okay, to sell if it trades below that level. So just keep this in mind when we are looking at specific markets. So when a market succeeds to take out a previous swing, the existing orders on the order book get filled and essentially neutralized, so therefore reducing the amount of liquidity in the market. So let's just say again, I'm long, and the market goes down and trades below that level. Now all of a sudden, I am out of the trade. So my one entry, so let's say if I go long one, and my one sell stop is here. As soon as it trades below that level, this order gets deleted, right? Because as soon as it gets filled, my order is off the order book, right? So my order is now neutralized. And what happens is smart money will often buy up those orders. So if I'm looking to sell, smart money will buy those orders. And this is what happens where markets trap traders. And this is the narrative that we need to think about when we are trying to build a trade idea around using liquidity. Okay, so what is the reasoning? So if they go down there and neutralize these stop losses, why would they want to go back down there again? All right, if they've already neutralized me out of the marketplace and they've gotten a really good entry right here, let's say if they entered as soon as they took my stop loss, and now their stop loss is down here as smart money. They've gotten a really great entry in here as smart money. Why would the market want to go back again and take out that low? All right, that's what's going to create different conditions in the marketplace, which I'm going to talk about next. Okay, so example 1, where the market fails to take out a previous swing, creates low resistance liquidity. And example 2, where the market succeeds to take out a previous swing, creates a high resistance liquidity point. All right, and just think logically. If they're leaving old lows in place, what's happening is they're building up liquidity to possibly be taken out at a further point in time. So when I see markets that are continuously creating lows like this, I have to be cautious and aware that they may be building up liquidity to just take out at a later point. So when the markets are stair-stepping higher or lower, right, if they're stair-stepping lower, you have to be very mindful that they might just be building up liquidity to be taken out at a later date, all right? Because as the markets trade lower, there's more and more money that's being built up into the market. And that's what we are trying to visualize as far as Jim Rogers' quote is, you know, I'm waiting until there's a pile of money in the corner and then I'm just going to pick it up. And this is essentially the move that he's trying to participate in, right? When we have a large pool of money being built up, they're trying to trade against the overall narrative, all right? So most traders that I know are contrarian, or a lot of successful traders are contrarian traders. They like to think against the herd. So when you see the herd moving in one direction, they're thinking like predators, and that's how you should be thinking when you're trading the markets, okay? So what to look for? When we're planning trade ideas, we are searching for price levels that are clean or low resistance and don't experience deep runs. So yes, you can have a very shallow run like this, where it just narrowly takes out the high, but that doesn't necessarily mean that that creates a high resistance liquidity run, because if it's not a deep run, what you're looking for is a really deep run and then a closure as a failure swing. So if it's just a very shallow run, I almost view that as clean levels rather than a high resistance liquidity run. And when I get into some of the chart examples, I'll go over a few. So our bias or sentiment should align with a trade that makes sense to target these levels. So if we see a pool of equal highs or a liquidity pool, even if it's something like this, all I'm seeing right here are dollar signs. I'm not really seeing those highs. I'm just looking at it and just thinking, oh, there's a lot of money up there. All right, and visualize this and really think about this when you're trying to plan your trades out, because this is how you should be thinking when you're trying to create a bias and have proper targets, okay? So when we have these liquidity points, these become our targets, right? You're trying to aim for that pile of money. So we can also use the creation of high resistance liquidity points to tell us that the market has neutralized or trapped traders on the wrong side of the market to then continue in a specific direction. And all we need to do is get on board. So when we see a run on a specific high and then it collapses and then we get a market structure shift, right? This is telling us that this is a high resistance liquidity run. There's a whole bunch of buyers that get trapped up here and we're looking for lower prices then. All right, and then all we have to do is just get on board. Even though it might be creating low resistance liquidity on the way down, there may be targets that are further below the market that we can target and continue that trend lower before we expect the low resistance liquidity to be ran out. So I'm just gonna hop over into some charts real quick, and we're gonna go over the 4-hour time frame, and we're really just gonna dive in and look at some of this price action and really give you guys a narrative on how to read low resistance liquidity runs and how you can use them as your targets. So right here, I'm just going to talk about visually what we're seeing, right? So what we're seeing is we're seeing sell stops being built up below the market. Okay, so anybody that was going long in here, anybody that's going long in here on the way up, let me just change this to red just to make it easier. Anybody that's going long inside of these levels, right? They're putting their stop losses below these old lows. But what happens is when the market fails to take out this old low, right? What happens? More money is being built up in here. That's a really terrible dollar sign, but you guys get the picture, okay? What happens is it runs to this liquidity, and you guys can see that here's a point of low resistance liquidity. So what I like to do is put LR as a low resistance liquidity run. All right, these become low resistance liquidity runs. Now what happens here is we purge this buy side liquidity, and you guys can see the reaction. And what you're really just looking for is when we're taking out that liquidity, it now becomes high resistance. So after taking out this liquidity, even though we did trade lower, it did create low resistance liquidity here, and we traded very slowly in here. And this is why it becomes high resistance liquidity. Is when we have a level like this, typically you might see a period of consolidation where it's going to take some time to trade to. All right. Whereas this, I would say a lot of this liquidity that was built up here, it's moved there with, I would say, much more speed. But what we're looking for are just old highs being taken out and using low resistance liquidity as our targets. So here we have an old high, and this becomes high resistance liquidity because we've already taken out buy side. So when we take out buy side, this becomes a high resistance liquidity point. So as you can see, when we take out that previous high, it's creating a higher high in the market. So what I'm looking at is just the narrative behind why I would do something like this. So what I'm trying to anticipate is buyers that just dried up. So if you were looking at the order book, the bids just dried up here, right? If there was more buyers, we would have closed above this high. All right, and yes, you guys are going to be probably raging at me and saying, oh, the market's run by an algorithm. Whether it is or it isn't, do I know? I have no idea. Do you know? You probably have no idea either. What I'm trying to paint the picture is how you should be thinking about the market narrative. How do you build a narrative? Whether the market is driven off an algorithm or whether it's not, I'm just trying to look at these charts and determine the levels of emotions that are going on in the market. Who's getting trapped off sides? Which market direction is price likely to trade towards? All right, that's all I'm thinking about. So after we see a lot of buyers get trapped up here, then what is our possible target? Well, we have all of this sell side liquidity being built up now. And even here, you can see that this here is a high resistance liquidity because it's going and creating a higher high. So even if I drew this level of liquidity all the way out, it's very similar to this small run in here. When we fail to trade continuously above that old high, that's creating high resistance. All right, and you guys can see that this market has really struggled to trade higher. It's really just been sideways. We had a really deep sell-off. We have some liquidity up here, right? Even this low resistance. But what I'm looking at is the bigger narrative. The narrative was possibly from down here. We have this money down here, which is just sitting here. All right, so anybody that's long has more and more liquidity being built up in here. All right, if we've already flushed out buy-side liquidity and have failed to trade higher, so we've taken out buy-side liquidity here, taken out buy-side liquidity here, you can really see that the market has really struggled to trade higher. And we have another example in here. We have low resistance liquidity, right? Traded to that very nicely, but it's failed to trade higher. So this here now becomes high resistance liquidity. All right, so it's gone up, taken the previous buy-side liquidity here, and then collapsed. When we get a market structure shift, now what are we looking for? We're looking for a possible target to trade towards, which becomes these lows down in here, because there's a lot of money that hasn't been purged out of the marketplace. All right. As we trade further into the lows, what happens then? After we've taken out liquidity here, and I'm just really trying to help you guys understand how I think about markets. When we flushed out this sell side liquidity now, what might the market do? If it wants to generate more interest and it still wants to trade lower, then typically what you will want to see is it trade below this low and then really strongly reject away. This, in my opinion, is really just one big engineering of liquidity. So what we're looking at is a failure to run below this old low, and this becomes a very clean level. So what's going to happen is they're really only going to trade it back into the range to generate more liquidity. So what's happening is they're generating more and more sell side liquidity. As this market trades higher and higher, what happens is they continuously generate more and more sell side liquidity. So at each time it creates new lows in here, it's generating more liquidity. And really all it's doing is trading above this low resistance liquidity, right? So you guys can see that there's a battle going on between both sides of the market. There is opportunity on both sides of the market. It's just how can you read it properly? How do I read these markets properly and plan a trade that makes the most sense to me? You can be right, you can be wrong. I could be right sometimes, and you guys can be wrong sometimes, and it's a constant battle. So just because you're wrong one time doesn't mean that you're gonna be wrong in the future. All right, and sometimes there's sometimes where traders have two opposing views of the market, and they both make money. It's just about how you plan the trade and how you manage the trade, which is the most important. So after we've taken out buy side liquidity here, again, what happens? They're just aiming for that pile of money that's in the corner. And this level down here, in my opinion, is probably one of the cleanest levels. So as we're trading, this level down in here becomes a really like big red flag if you're trying to go long, all right? Because when markets trade away like this, all I'm thinking is, well, they've kind of engineered these lows, because what happens is you have an order book that hasn't been neutralized, all right? What you're looking for, even from a short-term perspective, to neutralize an order book is for it to trade below an old low and then trade higher, all right? But what happens here is we have a level that becomes too clean. So this becomes a low resistance liquidity run. And what happens is when the market shifts structure, it becomes very easy to start targeting those old lows. So there's no real major fight back against this bearish trend that occurs, right? So then what happens here is, right, we've taken out sell side liquidity now. And then what we're going to possibly start targeting is what? Buy side liquidity. And when we get a failure to run lower, right, and we get all this consolidation, what we're looking for is a level of liquidity that makes sense for it to trade to. So yes, we do have a high resistance liquidity run here, but look at all of this liquidity here. So if I had to, pick and choose which pile of money has more money, it's going to very easily be the one that looks very clean. We have a very clean trend line like level. So if I had to, guess where all the money is, right, it's above this high, but if I had to guess where more money is, it's all of the money that's up here, right? Because none of these highs were taken out. And that's essentially what I'm looking for when I'm trying to position myself in a market and target specific levels. Are levels very clean and very clear that make a whole lot of sense for us to trade to and really flush out, okay? I could go on, but I think that's a lesson for you guys to really understand and figure out, how do I want to trade? Because there is liquidity on lower time frames. There is liquidity on higher time frames. Which one are you going to target, and how can you frame a trade properly? Because what I could see here is there's small runs on liquidity, right? Counter trend to the possible draw overall. So when we get a rejection from an old high, well, what am I possibly going to look for in the short term? I'm going to look for a low resistance liquidity run where the market hasn't taken out lows. You guys can see here that none of these lows were swept from the swing lows that were put in place after the fact. So each time it's retested to that level, it's failed to take out the previous swing low. So each time it's doing that, it's building up more and more liquidity. And then when they get enough people off sides, so everybody that's going long, right? They're going long in here, and what's happening is they're putting their stop losses below these old lows. So they're engineering all that liquidity, and then they're taking them all out. And this is why, there's a whole bunch of quotes out there, but I think there's a pretty famous one where somebody mentioned, the market's really out to fuck everybody, as many people as possible. And that's essentially the mindset that you need to have when you're trying to go against the herd. When you're trying to go against the herd, you have to think like that predator. You have to think like the person that wants to go and take people's money. And when you're analyzing charts and trying to study liquidity, all you're trying to do is understand where is the most money resting in the markets on this specific chart. So after we've taken out, even a short-term low, right? If we get a rejection, then what are we looking for? We're looking for a possible run on buy-side liquidity. So these highs become very vulnerable, right? This high becomes vulnerable, right, compared to this one. And it's just as a dance between buyers and sellers in the market. That's really essentially what it comes down to. So, when we have old lows being built up, they become very suspect when we fail to displace above previous swing highs or previous swing lows. That's what we're really looking for. And it's a constant level of analysis that's going into, managing positions and creating positions and understanding where are my targets going to be? What makes the most sense from a narrative standpoint? When markets fail to create displace below old lows, well then, if it's wanting to trade in another direction, where is the draw going to be? Where is the money resting in the market, right? It's always going to be above previous highs and previous lows. And this is just something that you guys need to go in and practice and be comfortable enough to try and make an analysis of the markets, place your trades, and then journal your results. Because you're not going to win every single trade. All right. There's no way that you're going to win every single trade. It's just about coming up with the proper structure and a real narrative behind why you're taking a trade. Because if you can properly do that, you're going to have much more confidence in holding the trades and waiting for them to actually pan out in your favor, rather than just going based off of a hunch. All right. So we have all these clean lows in here. You can see that, you know, there's a shallow run on them. They want to run it out further. What does it do? Creates this low resistance liquidity point, and on and on and on. So as you can see, there's liquidity being swept on both sides of the market all the time. You know, there's plenty of opportunities to position yourself where you're going to be targeting levels of liquidity on different time frames. Maybe you're counter trend some days, maybe you're trying to trade with the trend some days, but it's really a dance of trying to understand which direction the market is going to go. You're not going to get every single trade right. It's just about planning it out properly, understanding how liquidity works in the market, understanding the emotions, most importantly, that you see in the chart. So I can think one of the biggest edges that I have is trying to put myself in the shoes of somebody that might be trapped in the markets, right? Or trying to put myself in the shoes of, where would the most pain be inflicted on the markets if they were to trade to specific levels, right? Very, very important. It's very important that you guys come in here and study these different low resistance liquidity conditions where it's taking out highs or failing to take out highs and creating, more and more low resistance liquidity as the market's trading around specific levels, right? And seeing the result of markets after they take them out, right? So when this market's trading up here, this becomes very suspect. And if you take a loss here, you have to understand that, all right, well, if I went long in here, there's a reason why I took a loss, because it was low probability in the first place. The fact that we have equal lows down in here automatically should degrade your trade. If you were to grade your trade, it automatically should not knock it down from, let's say if you thought this was an A+, it should automatically be a B- or a C, just for the fact that you have a vulnerable level below you, okay? So, I urge you all to really study the markets and their reactions and really take time to understand them. Because if you see a level of liquidity, you might not understand if you have that level of liquidity right or wrong for quite a long time. And it really comes down to you having patience and waiting to see the full picture pan out. Because it might take some time for it to actually pan out in your favor and for you to get the real picture behind the market move. So that's an important part of journaling, is to plan a trade and then follow that market thoroughly for the next couple weeks, and then see how the liquidity is being engineered, maybe, or where they're trying to trap traders off sides, where it's going to run to after the fact, right? All these things are extremely, extremely important for your growth as a trader. All right, guys. So I hope you guys enjoyed this lesson. If you're looking to learn how you can trade live with me each and every week, ask me any question you want and get direct access to somebody that has 13 plus years of experience, make sure you book a call using the link in the description. Also, don't forget to like, comment, and subscribe to the channel, as I'm dropping free value every single week, and I'll see you guys in the next video.